Hello, everyone. It's Larry Kotlikoff back with Economics Matters, the podcast. I'm delighted to have Kevin Esler back with me today. He's the author of tipsladder.com, and we've had a discussion about tipsladder.com. It's an extremely useful tool for building a ladder of secure payments. It can be real payments, inflation-adjusted payments that occur in the same amount every year for a number of years that you would potentially specify, or it could be a one-time amount of money that you need to secure in today's dollars. So Kevin has a extensive history of working in the technology world. I think you worked for Disney, if I recall right, for many years, and other software companies. Well, Disney's not a software company, but you were working for the software part of their enterprise. The way I got interested in Kevin's work is through my software company. Maxify Planner is our main tool, and Maxify is trying to secure your living standard. And the safest asset that one can use these days to secure one's living standard are TIPS, Treasury Inflation-Protected Securities. These are like Treasury bonds, but they are different insofar as the coupon payment, the interest payment in effect that you get before you get your principal, that's adjusted for inflation. The adjustment itself is taxable, because our government taxes nominal interest income, and with that problem arises with any investment that we make, any asset that we purchase, stocks, bonds, real estate. We're all being taxed on phantom income, the inflation area aspect. But anyway, if you hold tips outside of your retirement accounts, then every year that you get a coupon, the inflation protection is going to be taxed along with the real interest. And then the principal comes out without any taxes, whereas the money that's inside a retirement account, whenever you make a withdrawal, if you're making a withdrawal from, let's say, a TIPS investment, whatever you take out will be taxed at the entire amount. Principal plus accumulated interest would be taxed at ordinary rates. But anyway, so I was interested in trying to figure out, how can we help people, since the program is saying, our software is saying, here's how much you need to withdraw from regular assets, and here's how much you want to be withdrawing from retirement accounts, given when, required minimum distributions, and also your own preferences about taking out money from your retirement accounts. When are these withdrawals going to occur, and in what amounts? How can you insulate them from inflation and from fluctuations in asset values just by buying TIPS? And that's what brought me to tipsladder.com, because Kevin has this fantastic tool to help us make insulate withdrawals from either regular accounts or retirement accounts from these factors. So Kevin, welcome back to the show here. And you've been really busy the last, we just had our podcast a couple of months ago, I believe. And here you are with some major improvements to the tool that would be good to go over. So maybe you can just kind of say a couple words in general that to add to your biography here, and then take us through the tool I've put on screen sharing, so you can show everybody what you had before and what you've added.
Yeah, thanks, Larry. I think it was about a year ago when I put up the original version of tipsladder.com, and it handled basically one use case, which is given some parameters which you enter in on a form, generate me a tips ladder automatically. So I don't have to sit in a spreadsheet and do the hard work. And the main parameters you give it are the years you want to be funded and how much money you want every year. There's a few other ancillary parameters as well that control precisely which bonds get selected and so forth. All right, so we're looking at the old version, and it's just a fairly simple form in which you enter your parameters. So here we're getting a 10-year ladder giving us $10,000 a year, and then
So
you.
Kevin, it might be good if you could kind of hit the Control Plus or whatever to try and make
Okay,
it
yeah,
bigger for the viewers.
good idea. How's that?
That's good. Great. Perfect.
That big enough?
Yeah.
Okay, so once again, this is the old version of the tool. You fill out the form, and
Well,
it
the
does.
other thing is you could probably expand this to the entire screen. That would help.
Okay. There we go.
There we go. Yep. Perfect.
And so you hit the button at the bottom hit the button at the bottom, and you get back basically a shopping list of bonds, which you take to your broker, and then you've got your ladder, and just sit back and receive.
Yeah, let's go back to the previous screen for a second just to show what the inputs are, because so this is, you have some default inputs which help you kind of choose, particularly, look at different tips, because not every, you may want to acquire real dollars in 20 years, but there may not be a tip that comes due in 20 years. There may be tips that come due in 18 years and one that comes due in 22 years or 21 years. And there's issues of which one you want to choose. And the default here is that you want to choose the tip that comes closest to the year that you want the money. That's called the rung year. But there's alternative options here that we explored in the prior podcast. So we won't get into those, but another option is whether you want the best yield or some other earliest to mature, latest to mature, because within a year, the tips you may want your money to arrive in the second half of the year, and it might come pay off, or the maturity date might be in the first half of the year. So there's those options as well. And then what else do we have here?
All right, so
You're in this case, you're saying that you want average income between the years 2025 and 2034, real income, as opposed to some minimum amount or some amount specified for each year separately. But so this is basically a smooth stream of $10,000 a year that you've are asking your tool to deliver. And then you hit create the ladder, and what do we see, Kevin?
well, there's three tables here. The main one is the top center one, and it tells you, it gives you a list of tips holdings to buy. So you print this out and take it to your broker, or log into your broker and buy those bonds. And they're for each holding, it's a QSIP, which is a unique identifier for a bond, and then a number to buy, a bond count basically. And and then here in the bottom right hand corner there, you got the total cost of this ladder. In this case, it's 101,767, and the two tables at the bottom are just a summary of the input parameters you provided, and then over here, properties of the ladder generated, and
So in this particular case, are you using the coupons to fund the ladder, or are you just assuming the coupons are spent as they're received?
coupons from later maturing bonds are used to fund the current year. Yeah.
Okay, so if you, let's say, wanted money starting in 10 years to continue for 20 years, and you wanted 10,000 over that period, you have it starting right away in 2025. But let's say you wanted to start in 2045 and have money coming out through 2065, $10,000 a year. then the way this would work is that, well, maybe we could go back and just look at that
Yeah.
case.
Let's run that case. So let's say we go from
24.
2000, say 35, or let's go 32 to say, I don't know, 42
Sure.
and 10,000 again. So here we're going to get bonds. The first year that we want funded is 2032, which is 8 years away. So we create the ladder, and this is our shopping list. Now you'll notice here that to fund 2032, we didn't actually have to buy any bonds because between now and 2032, there are 8 years in which the bonds we're going to buy tomorrow to make this ladder, they'll be producing coupons. So the assumption here is that we're going to roll all those coupon payments up and fund the first year, 2032.
So it's
Now
important for me to just to interject here for a second and let everybody know that the assumption here is quite, appropriate and also conservative, which is that the coupon payments that you receive are reinvested, but at a zero coupon rate, at a zero yield, so that even though the current yield on the different tips that are prevailing might be, well, the summary right down on the bottom right shows 1.8%. That's the basically the average internal rate of return, average yield to maturity of this whole set of tips. The assumption here is that in producing this ladder and trying to get close to $10,000, and you see on the far right, in real dollars, in today's dollars, how much real income you're getting, and it's very close to $10,000, not exactly each year, but the coupon payments that arrive along the way are being reinvested at an assumed zero internal rate of return, zero real yield, to help fund the required $10,000 per year starting in 2030. I guess 2032 was our first start year, right? So
yeah, there was actually enough free ladder interest to help fund 2033 as well. We see that there.
right, yeah.
Okay, now that use of the pre-ladder interest is an option. You can just turn it off on the input form there, and the resulting.
Turning that off means, let's just say, turning that off means that you would spend the coupons as they arrive.
Yeah, use it to buy a fine wine or something, and
Right.
just but so it's not included in the ladder, and that the resulting ladder will cost you more because you've got to buy bonds to mature then in 2032 in this case.
Okay.
Yeah, so that's the old interface, and it just handles that one use case really,
Yeah,
which is
and let me just say that I've used this tool to buy tips, to build my own tips ladder, and you can call a broker up and give them this number, or you can just, if you're on a site like Fidelity, I use Fidelity, you can just say, let's say you're inside your retirement account, you could say, like to buy, hit the trade button and then say buy, and then it asks you whether you want fixed income or stocks or some other type of security. And I say fixed income, and then it asks me for the CUSIP, and I just copy that number off the screen from, let's say in the 2033 number, and plug it in, and then it lets me make the transaction. I can buy 5 of these, and ask me how many, and I say 5, and then I hit buy, and then bingo, I've done what Kevin's saying to do.
yeah. So that's the old version. It's been out there for years, been very popular. I used it myself by a tips ladder. So I guess I could go on to the new version. And if we go back to the landing page here, and I'll actually go not quite full screen here. Oops, sorry. Now, if we go back to the landing page, there is a link there right here to the new version. So if we click on that,
Cool.
we see the new version come. I'm just going to bring up one little slide over on the left here, which sort of describes what this thing does. Right over there. I'm going to get rid of that. It's okay. So, so whereas the old interface handles that single use case of what I call generation, it generates a ladder for you. It occurred to me a few months ago, well, probably about 6 months ago, that I could get a more responsive tool and also cover up some more use cases if I actually ran the calculations inside the browser instead of at the server. So that turned out to work surprisingly well, and that's how the new this new interface works. So it's actually running calculations inside your browser using code that's compiled to JavaScript. So it'll run on a phone or an iPad or anything. So here we have 6 sort of sub parts of the landing page. First 4 of which are separate use cases. The last 2, the catalog and the info, are kind of information. The catalog, I'll just quickly lists the current available tips out there. And info is just some stuff if you need to educate yourself about tips. So the rest of it, the main important parts are the first 4 use cases. And over here on the slide, I just want to describe what they are. Estimate, the first one, top left, that's for answering sort of an introduction to the tips ladder construction process. So it can answer the 2 questions that are usually the first ones that come to mind, which is, okay, I've got I want to get a certain amount of guaranteed real income. That's what the GRI stands for there. I want a certain guaranteed real income over a set of years. What's it going to cost? Can I afford it? And the converse question is, okay, I've got say I've got $500,000 in a stable value fund. What sort of guaranteed real income will that buy me in the form of a tips ladder over 25 years? So that's what Estimate does. And generate.
Do you want to just look at them one at a time? And
yeah, well, so let's go into that then and see what how that works. So here we've got these 2 sliders here. The top one is to select the years you want covered by your ladder. So let's say I get a I don't know. There's a 20-year ladder covering 2030 to 2049. And let's say I want, I don't know, 30,000 a year. Well, down the bottom here, as you move the slider, it's going to tell you the ladder cost and these other 2 metrics, which we need not to get into just now. And
let me just repeat this since I'm the teacher here. This is, by using the bottom ladder, you're setting, if you wanted to have 30,000 a year for a certain number of years, you would say, you use that bottom scroll bar to specify 30,000. And then in the top scroll bar, you would specify exactly the period. And you could make that period just 1 year. For example, I take it that you can make the beginning and the end the same number, right?
I think so. Yep, there's one.
So the reason that's important is that a lot of people think that the value of tips of this site, of this tool, is to produce smooth income. A lot of people in the financial world think that the goal of your financial life is to have a smooth path of income for many years. And actually, that's not what economics says. What economics says is that what you want to smooth is your spending. You want to have a smooth path of basically disposable or discretionary spending per household member, taking into account and of course, if your demographics are changing in your household, the amount of discretionary spending you want to do to give the same living standard per household member is going to differ. So if there are more mouths to feed, your discretionary spending to deliver a smooth living standard path it's going to be higher. And then when, let's say, the kids leave the household, it's going to be lower. So in addition, when there's, let's say you're just a single person and you have, this year you have required minimum distributions that you didn't have last year. So that means you have to start withdrawals this year, whereas last year you didn't have withdrawals. And the withdrawals may differ every year because even ignoring the minimum distribution requirements, you may want to start your retirement account withdrawals because you may have to, for example, send your kid to college to help them with the college expenses. So you may be planning to make a big special withdrawal from your retirement account when you're 62, even before your required minimum distributions set in, maybe from 62 to 63 to 64, and they could be different amounts every year. So what we find with Maxify Planner is that the required withdrawals from your regular assets are differing every year. They're not smooth, and the withdrawals from your retirement accounts that the program comes back with aren't smooth. So to me, most people who are using MaxifyPlanner.com, which, by the way, we're going to be integrating with tipsladder.com, and hopefully by January we'll have it integrated. But tipsladder.com will do things that are different than, well, I mean, it will still exist, but we'll be doing some of different things with Maxify Planner internally with Kevin's technology. But anyway, the main point I'm trying to make is that smoothness is not really what economics recommends. It really recommends irregular withdrawals that you want to insulate, and you can do that using this tool just by setting these two values to the same value, year, and then that's take care of 2030, and then you move to 2031, figure out from our software, if you're running our software, how much withdrawals you'd want to be making. And in any case, once you've decided what you want to do here in terms of the top bar slider, you can then figure out what it is you need to purchase by clicking on Generate and Refine Ladder. But Kevin, show us the other use case with these sliders, which is that if you only had a fixed amount of money to buy a stream of income, how would you adjust things to get to that fixed amount of money?
Yep, that's where the slider helps. So let's just say we want the same years covered. Well, let's say it's I don't know, 2029 to 2048. So a 20-year ladder, we've got $1 million. Just say we've got $1 million to spare, which is nice. What you do is you move this slider to the right until this ladder cost is just under the amount of money you have to spend. So we'll do that. We'll just keep moving here till we see something close to $1 million there in that ladder cost cell. So we're getting close. When we're getting really close, we can just use the arrow keys to bump it up. And getting very close, 980, 990. Okay, just over. So we'll get back one little slot. And yeah, it looks like, so the answer is, got $1 million to spend to cover those years, 2029 to 2048. We can get 59,900 a year in guaranteed real income. So that's the converse use case provided on this page. Yeah, so you do one or the other of those. You've either got the money to spend, or you either know the money you have to spend, or you know the income you want. Having moved the sliders to the right place, you can then say, click this bottom button that says, go and show me the ladder that'll do this. And this brings up basically the same form that the old tool offers, which is half a dozen parameters there to control how the ladder is generated, preceded with the values that you just set in the slider. Now here we see the The way the new interface works is you don't submit the form to the server. You get the results immediately in this panel below here. So we see a bunch of ladder properties, and you can tweak the parameters at the top, and you'll see the results instantly in the bottom. So we have ladder properties. We have a description of the rungs or the funded years. We have the purchase list, the bonds you need to buy. Let me just make that a bit wider. And finally, a cash flow calendar. So I'll just show how that works a little bit. If we go back to ladder properties, you see the cost here, 997,116. If I was to tweak something up here, like instead of wanting average income, I want a minimum of 59,900. You see it immediately generates a new ladder and displays the properties here. So you can, interactively tweak these until you have what you want.
And the reason minimum would be you're using is it's very hard to get exactly the same amount every year given the coupon. So when you put in average, you're trying to average out to like the $10,000 goal, right?
Yeah, I'll show you how it looks like. We have here the rungs. Now, if we go back to average, we'll see that some of these are lower than 59,900. Some are slightly above, but they do average out to be 59,900. Whereas
Right.
set minimum, you'll see they'll all go to something above 59,900. So that's how average versus minimum works. Another nice feature, I think, of this tool is, or this new version of the tool, the cash flow calendar will give you a detailed list of promises as to when you're getting money. So here it's split up into years, and if you say, well, for that ladder, how much will I get in 2030? You can open up that year, and you'll see certain dates upon which payments occur. And these are guaranteed real income numbers, so they're in today's dollars, and when you receive them, they'll be bigger by whatever factor inflation has been. So yeah, open up a date and you see, okay, you'll get all these payments on that date. In the left-hand column, it says the TIPS holding that's generating the payment, the amount you'll receive, and the reason for it. So it's, in this case, mostly it's maturity and interest payments.
Well, that's really terrific because people can really see what's coming, when it's going to come, what month it's going to arrive. So that's really, really helpful.
Yeah, and this is also updated interactively if you adjust things up here, like yeah, it's updated as you tweak the parameters. The other thing here is you can download. There's a download button on the cash flow calendar, so it'll download a spreadsheet form of the calendar, so you can store that away and look at it occasionally. The other thing you can do with this is you can save your work. So say you're designing your ladder and you haven't quite finished, you can hit the save button and it store the URL file, which will bring you straight back to this page seeded with these parameters.
Will that store for more than 24 hours or about?
It's actually stored on your computer.
Oh, okay. So it's indefinitely, so that's terrific. What about rungs versus purchase list? How does that differ?
Yeah, this is a distinction I made in the new interface. I thought it was useful since we have this multiple tabs arrangement here. Rungs has an entry for each funded year and tells you which TIPS holdings are generating the income for that year, how much it costs, and then total income for the year, subdivided into principal and interest income, sorry. But basically, yes, it's a line per funded year. Now, I thought it would be nice to split out the purchase list. It's a sort of a simplified model of, doesn't look simplified, I know, but because sometimes you have holdings that fund more than 1 year. And here's an example in this row here. So I just wanted to purchase this to be what you take to your broker. Now there's obviously more information here that he needs, but it gives you some detail about, well, the current asking price, what you're likely to pay. Lots of details about the bonds you're about to buy. Well, it's just a different view of the ladder, I guess.
Right. Right. So maybe we should just take people through some of these things for a second. The years funded, let's say if we think about 2032, we're talking about a bond that's going to mature in, I guess it's going to be April. That's the maturity date.
Yeah.
And then we've got the coupon payment was the original, that was the original ratio of the coupon to the, is that the current value of the coupon rate, or is that the initial?
The coupon is fixed at the TIPS auction, I believe. So it's fixed for the life of the bond. So
Okay, right.
so every 6 months on the 6-month anniversary of the issuing of the bond, you get, and in this case, the coupon percentage, 3.375% of the current inflation adjusted value of the bond.
Oh, the principal, the inflation adjusted. So if you take the coupon rate times the inflation adjusted principal, so take 0.03375 times 17,969.94, you're going to get the coupon payments that you'll be receiving. If there was no every year, every 6 months, I guess, right?
Yes.
Is that divided by 2, or is that?
Yes, divided by 2. So you get 3.375 divided by 2.
Assuming there's no additional inflation, that's what you'd get in dollars. Even with inflation, it's the amount divided by 2 of that product divided by 2 is going to give you the real payment every 6 months. And then the yield to maturity, this is this the internal rate of return at this point?
It is basically. So this will vary depending on the fluctuation in price of that bond, minute to minute, basically.
Okay. And these yields to maturity I see are differing depending on, so the bonds that are maturing later in the in time are producing a higher yield to maturity, or have a higher yield to maturity, because that's just what the term structure, the kind of curve of the yields with respect to the maturity length, the length of how many years it takes to for the bond to pay off fully in terms of the principal being disgorged. That's the maturity date. The term structure right now is upward sloping as opposed to downward sloping for TIPS. So that's what one sees right here. And if you went back a few weeks ago or a couple months ago, all these values would be probably, well, the yield to maturity for a 30-year TIP was running, I think, about 2.3% back a few months ago. So I think the rates have come down significantly in just the last few months, but they're still pretty high relative to historical values. So this still remains a good time to be buying TIPS, although I'm not an investment advisor, so you'd have to check with a financial investment advisor. I'm just an economist. What's the Macaulay? Sounds like another Aussie name here. Duration. Is that somehow waiting?
Yeah, the Macaulay duration of that holding just says it's the time weighted. Let's see, no, it's the
probably the weight. It's probably the weighted average of the money that's coming out based on the number of years.
yes. So it's the weighted average of the time to payment, I guess. So it's for a coupon free bond, it would be simply the maturity date, but for For bonds with large coupon payments like that 33751, we see that the early duration date for bond maturing in April of 2032, the weighted average time to payment is actually in the previous year. So yeah, high coupon bonds tend to have shorter duration. I just put this in there because I think some people are interested in this. I don't know if it's useful to most people at all, but
Okay.
there was some Boglehead's discussion about using Macaulay duration to select the best bonds to cover the gap years, but that's a bit of a rabbit hole going down there. And but I did go to the trouble of including this metric in some of these displays.
Okay. So the so this is a bond that had a pretty high coupon rate when it was issued. Are all the tips initially auctioned at $1,000 price? Is that the way? How does it work? The people,
Yeah.
the bond costs $1,000, but what varies is the coupon rate, right? At the time.
Yeah, yes, that's about it. So yes, when the bond is auctioned initially, yes, they're worth $1,000 each, and the coupon rate is determined by the auction.
Right. So you can buy these tips either on the secondhand market through like, with a broker, or, if you do it yourself, if you have like an IRA and you're on a platform like Fidelity or Vanguard or T. Rowe Price or maybe Merrill Lynch, you could probably have the option to buy and sell securities yourself and stick in the QSIP, and then you get to buy yourself. But if you wanted to buy them through the Treasury Direct auction, I guess you put in a. Have you ever done that, Kevin? Bought tips?
I did actually one about a year or so ago. I did buy some tips at auction.
And you just say I'd like to buy so many 30-year tips at the prevailing coupon that arises in the auction. Is that the way it works?
Yeah, you get whatever the auction determines, and you've got to sign up a few days ahead of time. There's some time constraints about it, but I went through the process once. It's not The auctions aren't how you fund a tips ladder, because an auction is typically issuing a bond that's going to be just one maturity date, whereas when you're building a ladder, you want to cover a whole bunch of different maturity dates. So yeah, so you buy yourself normally to fund a ladder, you're buying bonds tomorrow to cover a 20-year period, and so you have to buy them on the secondary market.
Oh, because you can't buy, because the auction is just for one maturity, not for a whole bunch of maturities.
That's right. That's
Okay.
right.
And then so the inflation, if we look at this particular tip, the inflation adjusted principal. So initially this thing was, you could sell it for $1,000, you buy it for $1,000, let's say from Treasury Direct, you sell it for $1,000 a minute later, basically. But then through time, what happens is that the principal gets adjusted every year for the inflation as determined by the consumer price index over every 6 months. It gets adjusted upward. And then you take the prevailing principal and multiply it by the coupon rate divided by 100, this percentage divided by 100, and that gives you your 6-month coupon. Now, well, divided by 2, because that's an annual coupon rate. But this particular tip looks to have been issued way in the past, because the inflation adjusted principal is much higher, 77% higher than it was initially at, right? It was initially at 1,000.
We can actually click on the QSIP here, and we'll go to find out the details on the Treasury Direct side about the bonds. Let's just do that. And we see here that it was issued in 2001. So it's, I guess it was a 20-year tip, sort of, more or less, yeah. Yeah.
Okay, so there's been a lot of inflation. So it just shows you that we've had a 70 since 23 years ago, a hot dog was a whole lot cheaper. I mean, if you think about the price of a hot dog in 2001, it's now about 77% higher in
Exactly.
dollars. So if it cost, $2 now, then it's almost $4 today. And so this is very instructive because it's showing you the importance of having protection against inflation. If you buy nominal bonds, if you bought a 20-year regular treasury, the purchasing power would have dropped by about 70%. So you're getting eroded. Of course, you would have gotten a higher nominal interest rate to compensate, but inflation could have ended up being much higher than you were being compensated for because it was turned out to be unexpectedly high over the last 23 years. And certainly the last 3 years, prices have gone up by 20%. So part of the 77% increase has just occurred in the last good chunk of that in the last, and of course the thing's compounding. So it's compound inflation. Anyway, the ask price, let's just talk about that for a second. That's, you're buying this stuff on the secondary market, and that's what people are asking asking you to pay, right?
That's right. Yeah. So this varies, I think, from minute to minute. So yeah, this is what you have to pay to buy this bond today.
And the total cost of all the 27 of these would be 53,000, right?
Yeah. Yeah.
And what is the accrued interest cost? What does that mean exactly?
Okay. So the accrued interest cost is the interest due to the previous owner of the bond. So you're buying a bond from Joe Blow on the secondary market today. Now he's expecting, if he'd kept the bond, he would get the entire next coupon payment. But since you're buying the bond from him, you have to reimburse him for the partial coupon payment that he's not going to get.
So it could be that the coupon payment is going to arrive tomorrow. Maybe it's like June 1st or something. I don't know whether it's June 1st or June 30th that they pay it. Anyway, maybe it's June 15th.
So it's on it's on the maturity date anniversary. But
yeah. So it could be like tomorrow the thing is going to pay off. I buy it from you, Kevin, today, and I'm jipping you out of getting this payment that's going to come tomorrow. The coupon payment is going to come to me, so I basically have to pay you that amount that you're due, and then I'm going to get the actual coupon payment, the interest coming to me directly the next day. So that's so the net cost here is in other words, you have to pay two things, which are the bond costs and the accrued interest costs, and then the net cost of the 27 tips here would be 54K. Cool. Okay, let's look at the other reports that you have in your new screen there.
Yeah, let's see. Well, we have data properties, which is really a summary of what's going on as you tweak the parameters. We've got the years funded, which is 20 here. Total cost of the ladder, and total income generated once all the bonds have matured. I calculate the internal rate of return of the whole ladder. And then let's see, we'll skip over withdrawal rate. We'll say the average per year is 59,934, which is just a bit more than what we specified.
Right.
The minimum per year is 58,560. The price date is the date for the pricing we're using to the pricing the ask price we're assigning to bonds, and that's typically the day that the most recent bond trading date. So today is the 28th. Well, bonds traded yesterday, so the price date is.
Yeah. So it's important, everybody, to realize that this is not like real-time pricing. instantaneous or nanosecond pricing. It's basically priced. Kevin's tool here is giving you prices that were for sure yesterday, not this minute. True?
Yeah, and there isn't actually a single price even at any 1 minute. I mean, you can get a different price at Schwab and Fidelity. So it's important to realize that the cost here is an estimate. And when you come to actually buy the ladder, you may need a little more or a little less, depending on how the prices have moved since or which brokerage you're using. I remember when I purchased my ladder, I was pleasantly surprised that it was quite close. So it won't be too far off.
That's good. Now, if we go back to your the new screen here, you had 4 things for us to look at, right? We've just basically looked at examine, right?
Yep, so we'll go back to
Home. Yep.
our slide on the left here. So we looked at the estimate and the generate use case. The
Okay.
other thing, there were 2 other use cases that some people wanted, and so there's the build use case, which is get out of my way. I know what bonds I want to buy. Just let me choose them. And so it gives you the ultimate flexibility. You can actually go there from a generated bond. So here we've got a generated ladder. Here we have a generated ladder. We can go to the build page by just clicking refine ladder by hand, and we see this. This is a bond ladder editor page. So it's pre-populated with the generated ladder, but we can tweak it to our heart's content. And down the bottom, once again, you've got the same purchase list. And
Show people how you tweak it.
okay, so just say I want to add. Let's see. I think I can add a later year. Let's just say I want to add a year at 2049. I say, okay, add that year. I've got an extra year up here. Currently no bonds selected, but it presents, if I expand that new year, it shows me what bonds are maturing that year. Typically it's only one, but sometimes it's more than one. And here I can say, well, let's see, I want about 60,000 a year. Let's get 50 of those, I guess. So if I type in 50 here, and we now have a new ladder with an extra year added up here at the far end, the later end. It's giving me a bit too much, so maybe I can whack that down to 49, and maybe I just go one further, 48. Okay, 59,928. Okay, happy with that. So yeah, 59. Oh, sorry, that's the principal. Yeah. So the income is just above 60, which may be what I want.
Right.
You can add years at both ends. You can actually delete years. Maybe I just changed my mind about that. I can throw away that one. Back to my generated bond. I can add earlier years at the other end. So it goes, the earlier years are at the bottom of the page for various reasons. So just say I want a rung at 2029.
Okay.
Create a new row. Okay, what bonds are available here? Oh, there's quite a few. There's 5 different bonds that mature in 2029. Well, gee, I don't know what to choose. Coupon. What if I
Combination, yeah, I guess. Or the so they're different yields to maturity because yeah, maybe why does one, for example, do you think have the 1.47% yield to maturity? We're about 5 years away from 2029. These things are going to come due on different months in 2029. Why is it that one has they have different yields to maturity that are pretty different?
Yeah, good question. I'm not real sure. It's the market doing that. I'd have to think about why that is. In theory, they should be all close to the same number, and in fact, they are fairly close here. But no, that one's quite a bit off.
Yeah.
I'm not sure. I'm not sure why this is.
I've seen this kind of these anomalous things that, uh, well, I mean, this is very useful because you can see kind of what's available, and you
Yeah,
certainly want to go for, I think you want to go for the highest yield. I don't think there's any
right.
difference in tax uh, issues here between these, but
Yeah, I mean, some people might want one of each. Maybe they want payments spread out through the year, or maybe they want it at the end of the year. All of these columns are sortable. You can just click on the header and it sorts. So,
right,
like, so yeah, generally the default option probably is just buy the one with the biggest yield.
yeah,
So let's do that here. We'll say, let's see, well, I don't know, let's get 30 of them. Actually, let's get 14 of those and 16 of those. And so the result is we're getting 57,000 in that new early year.
right. And you can also use this pre-owned, this particular screen to adjust, let's say 2033. You can hit that greater than sign, and you can lower or increase. So this is actually kind of ideal for, you could say, look, I want to take withdrawals for sure, maybe from my retirement, my IRA, and I want to buy tips in my IRA, but the withdrawals are going to be irregular, different every year. They're going to be on average maybe 50,000 bucks, so, or 30,000, whatever. So I could start out off with a ladder that's 30,000 every year, and then modify that based on how much I really actually want to withdraw in each year. But I have a starting point, so I can just play around with each one of these years, up or increase or decrease the amount of the tips are being used to produce this ladder, and and then have an irregular payout, which is again what I'm saying that economics is going to be recommending happen. So, Kev, let me ask you if you could go back to the screen where you had the menu of like 6 different items.
Yep.
Yeah.
So we covered the first three.
Oh, we have, okay. Oh,
Yeah.
that's the ladder by hand. What about the analyze? That was one we haven't, right?
Yeah, so the analyze is the fourth one, and just got to handle a phone call here. But analyze is another use case that people were requesting, and this covers the case where somebody who's bought a few tips over the years, maybe perhaps at auction, and now they're getting closer to retirement, and they want to build a ladder based on the tips they already own. Okay, so that's what this case does, and let's see how it looks. So you essentially start off with this one, and you build you enter a tips portfolio that you already own. So you say, okay, I already have, say, 10 of those, and I've got, that's 2025. Maybe I bought some that mature in 2027. Whoops. Let's add, like I said, I've got a 2025. We'll add a row, and we'll get a 2026 bond. So we've got 10 of those. And then we've got, maybe we've got I don't know, 2030 bond. Where is it? There we go. Oops, sorry. I should have added the row. Go back to 20, correct myself, add a row. And then, so 2030, I said, there we go. So that one, and we'll have 10 of those. So just say, over the years, I've got bought 10 of each of these bonds, and I'm getting close to retirement. I'd like to build it out into, say, a 20-year ladder. Now we see below here the properties of the portfolio. We've got 6 years funded, and it gives you, the other metrics, but it's not a particularly smooth cash flow, I'm guessing. Let's have a look at the cash flow calendar. Yeah, we're getting a big bunch in this year, 2025, big bunch in 2026, not much for a few years. and then a big bundle in 2030. So what you can do is you can say, extend this to a ladder. So you've entered your portfolio. You say, okay, now I want to turn this into a full-blown ladder with, maybe perhaps a uniform income distribution or a lumpy one, whatever you want. So we get the extend to ladder, and that throws us back into that previous build editor that we saw. And here is where you extend you might add some years, 2031. You might want 10 of those,
Right.
and so forth. So you fill in the gaps in your portfolio, and you tweak the numbers and the bond selection until the metrics down below here are roughly what you want.
Right, and the pattern of the total payout at the very end, last column, is what you want. So, and this is also useful. It might be that you actually need more income earlier on because things have changed than when you bought your TIPS portfolio a couple of years ago. So it might be that you have more real income coming in, let's say, 18 years than you really want in 18 years. So you can figure out, hey, I can sell some of these bonds and use that to fund TIPS that I bought that are going to yield income in earlier years or even in later years. So this is not just a tool that can be used to help you think about what you need to buy to either smooth your, in addition to what you already have, to smooth your future TIPS income, but also whether you want to be selling some of the TIPS you've already bought to achieve the current desired pattern of real income that's now relevant because things have changed compared to where you were in the past. So anything else we should tell people, because we have spent about an hour at this? What do you think, Kevin?
I think that's about it.
Why don't you turn off the share screen? I think you
Yeah.
just hit escape there and we're back together. Yeah, this is every time I talk to you about your machinery here, I'm learning, you're educating me about how TIPS actually work. So I'm not the full expert you are yet, but getting there. But this is, I think, enormously useful for people to produce a smooth or lumpy ladder, to modify it, to know what's coming, when it's coming, to think about the taxes, because if you realize if you're going to get this much real income and you project what the inflation is going to be, that coupon payment is going to be what it is in real dollars, increased by the projected cumulative inflation. And so there's going to be a real coupon payment plus the inflation component, but you're going to have to pay taxes on the total. So this can give you an idea about your taxes as well. Of course, if you're using Maxify Planner, the program is going to produce what is going to help you figure out what your taxes are, because we're assuming people are investing in safe assets yielding. Our default is that people are investing in assets, basically in TIPS that are yielding the prevailing the TIPS real yield that was prevailing either in January or June. We update twice a year, and the integration that we're going to be we're working on with Kevin is going to let people run the program, and then it's going to show them the TIPS bonds they would need to buy to match up with the withdrawals from the regular the regular asset accounts, from the regular assets, as well as the withdrawal from their retirement accounts from their IRAs. We'll have two sets of TIPS purchases that would produce line up with those withdrawals, and that will happen automatically once we get the integration to happen. So anything else to say that you want to, any final words?
Not really. That's where it stands at the moment. I don't know if I'll add much more to this tool. I have a few ideas about just completing some of those use cases. Like right now, the use case of building out portfolio into a ladder does not allow you to look at selling current bonds. I could change that, and yeah, that's probably a good feature to add. But beyond that, the other thing it doesn't do, I should point out, is I don't know, it doesn't do a lot of things, but
Well, it does do a lot. I mean, to me, it does a huge amount.
I think it covers most of what the average investor needs, and yeah, I'm not inclined to do a whole lot of work to cover use cases that are
Yeah.
not needed by many people. So
Okay, so one final word of warning to people, which is that, we've been gung-ho on tips in this podcast and the prior one. And was certainly very gung-ho when the yields were higher. The yields have come down. So one wants to think about, will the yields go back up? Is this the time to be buying tips? It's possible the real yields could go back up. It's also possible they could go down. If you go back to like 2019 or 2020, I think the real yield on tips was negative 0.5%. Today we're talking about long-term yield about 1.8% positive. So, and that's probably as high as it's been in the last 20 years or so, even though it's lower than the 2.3 for long-term tips that was around a few months ago. So there's the issue of when to do this, looking at the real yield in the term structure. There's also the issue of, could the government default on its government bonds? Could the federal government do that? Many other countries, starting, I believe, with the British, maybe in the 13th century, certainly the Spanish are very famous for their major default in 1575. And Argentina defaults all the time on its debt, right? Could the US default on its debt? Well, I think the country's broke long-term unless we get some sensible fiscal policy in place, so possible. And could there be high inflation in the future that makes those coupon payments that are real, but the inflation adjustment means that you're going to be taxed on that in addition to the real coupon. So it's really the nominal coupon you're going to be taxed on. Could inflation in the future that's risky make the after-tax return on these tips risky? Absolutely. That's definitely the case, because we don't know for sure what inflation will be. Therefore, we don't know what the taxation on any tips that you buy will be in the future. So with those words of warning and the acknowledgement that we are not financial advisors, we're not tax advisors, we're not investment advisors, we're just education, we're just teachers, really. And this is an educational podcast. So I want to thank you, Kevin, for rejoining us, for making this huge contribution to everybody in providing this tool, and look forward to, as I said, integrating your tool with our software, maxify.com, and to talking to you again on the podcast down the road. Thanks again.
okay. Thanks for having me, Larry. All the best.